In prior videos, you learned how to calculate gross pay and whether the employee's payments for fringe benefits are pre-tax or post-tax. Now we're ready for the next step of calculating federal income tax withholdings under the wage bracket method, one of the ways to calculate federal income tax. Another way is the percentage method of calculating federal income tax, which is covered in a separate video. You might be wondering why you're learning the manual method of calculating federal income tax withholdings for a paycheck. After all, there are a lot of payroll software programs that will do that automatically for you. One of the reasons is that as an accountant for a large company, you might be involved in system testing and you want to make sure that the system is still functioning as expected after an upgrade or other change. Typically, you would be expected to test the calculation and document your findings. In addition, it is helpful knowing how to manually calculate the federal income tax when an employee disputes the tax withholding on their paycheck. Federal income tax is considered a mandatory deduction for all employees. It is an employee-only tax, which means that the employer does not contribute a matching amount like employers do for FICA tax. The employer's role in terms of federal income tax is that the employer acts as the collector and depositor for these funds. When the employee files the income tax return, the amount withheld from his or her paycheck during the year reduces the amount they may have to pay with their tax return. The starting point for calculating federal withholdings is the Form W-4, which is completed by the employee on paper or online. The next step is the federal taxable wages, which are calculated by subtracting pre-tax deductions from the employee's gross wages. Pre-tax deductions are the employee's payments for health insurance, 401k, and cafeteria plans. Many companies use software programs or an external service to calculate the federal income tax withholdings for their employees' paychecks. However, if a company uses a manual system, there are two commonly used methods for calculating federal income tax. One, the wage bracket method, and two, the percentage method. Just remember that pre-tax deductions reduce the gross pay to arrive at taxable income. That means that we take the gross pay and subtract any pre-tax deductions such as 401k and health insurance to arrive at the amount we will use to calculate federal income tax. In addition, the income tax liability is reduced by credits for children and other dependents. Let's look at two examples of how pre-tax deductions reduce period wages to arrive at taxable income. The first example is for Heather, who is single and did not check box 2. Has biweekly gross pay of $2,815. She elects to have 5% of her gross pay withheld for a 401k contribution and has no other pre-tax deductions. What will her taxable income be for federal income taxes? We start with a gross pay of $2,815 and then calculate the 401k deduction, which is $2,815 times 5% or $140.75. Subtract the pre-tax deduction from the gross pay, which results in Heather's taxable income of $2,674.25. This is an example of an employee with pre-tax deductions, which explains the difference between the gross pay and taxable income. Could the gross pay and the taxable income be the same? Absolutely. If the employee has no deductions, such as health insurance or 401k that qualify to be deducted pre-tax, the employee's gross pay and taxable income would be the same. What about the next example? Bellamy has biweekly gross wages of $950, uses the marriage filing jointly tax status, and checkbox 2 on her W-4. She subscribed to the company's cafeteria plan and has agreed to a 10% contribution of her gross wages in a qualified 401k plan. Bellamy's portion of the health insurance is $56.90 per pay period. So we start with the biweekly gross wages of $950 and calculate the contribution to the 401k by multiplying $950 by 10%, which is $95. We write this amount down as a pre-tax deduction, then enter the pre-tax deduction for the health insurance of $56.90. After subtracting both pre-tax deductions, we arrive at the taxable income of $798.10. Let's now talk about the wage bracket method for calculating federal income taxes. The first step of calculating the taxes is to identify the individual's marital status, number of children less than 17 and other dependents, and taxable income level, and then follow the chart in publication 15T or in your textbook for the amount to be withheld. If manually calculating the wage bracket method, it is important to apply the appropriate number of withholding variables before calculating the tax amount. The wage bracket method is useful for manual payroll preparation because the process of federal tax withholding is an estimate for the year-end amount of taxes due. Let's look closer at this specific portion of the tax table. First, at the top, it shows the title, 2024 Wage Bracket Tables for Manual Payroll Systems with Form W-4 from 2020 or later. Below, and it's very important that you check this each time it is the time period. In this case, it is for a biweekly payroll period. Below that is that tax table that is divided into 4 major sections. In the first section, we have the taxable income amounts. Be careful to read the header, at least, and but less than. The 3 other major sections are married filing jointly, head of household, and single or married filing separately. Why does each section have 2 columns? Well, the first one is for standard withholding, and the second one is for employees who have chosen checkbox 2, withholdings on the Form W-4. For Heather, who has taxable income for federal income tax withholdings of $2,674.25, we find the row that includes this taxable amount and continue until we find the column that shows us single filing status and the standard withholding because Heather did not check box 2 withholdings, and find the tax of $276. Our next case is for Bellamy, where we calculated a taxable income for federal taxes of $798.10. Bellamy also has biweekly payroll and files as married filing jointly and check box 2 withholdings. We find the row in the biweekly tax table that includes the taxable amount of $798.10 and continue until we find the column that shows us married filing jointly status and the column for Form W-4 Step 2 checkbox withholdings because Bellamy checked box 2 withholdings and find the tax of $24. Here we have an example for Jerry, who's an employee at 123 Farms. Jerry is single with no dependents and earns $48,000 annually, paid biweekly. We'll use the wage bracket tables in Appendix C to determine Jerry's federal income tax in 3 different situations. First, we'll calculate the federal income tax withholding, assuming that Jerry has no pre-tax deductions by taking his annual pay, dividing it by 26 to get the gross wages per period, which is $1,846.15. We then go to Appendix C of your textbook or Publication 15T to find the biweekly payroll period for the wage bracket method. When looking at the tax table, it's important to ensure that you have the right table. We're looking for the table that shows 2024 wage bracket method tables from manual payroll systems for Forms W-4 from 2020 or later. We also need to find the table that shows biweekly payroll. Then we need to locate the correct marital status column and the correct wage row that shows us the wage we're looking for. For Jerry, we need to find the row that includes his wage of $1,846.15, which is about towards the bottom of the page. It is the row that starts with 1,835 and ends with wages less than 1,855. Then we move to the right until we find the standard withholding column for single taxpayers, and we find $145. How do the withholdings change when Jerry has pre-tax deductions for health insurance of $75 and supplemental health insurance deductions of $55? While Jerry's taxable income decreases to $1,716.15 because the insurance contributions are pre-tax deductions. So we now look up $1,716.15 in the tax table and find $131 in income tax withholdings. Our last example is like the second example, but we have an additional pre-tax deduction for 401k, deductions of $100, which lowers the taxable income to $1,616.15. Going back to the tax table, we find the correct row for the taxable income of $1,616.15, which is $119. Here's another example that illustrates the additional calculations that we have to complete when the employees have dependents. Wolf Industries pays its employees on a semi-monthly basis using the wage bracket tables in Appendix C or Publication 15T. Compute the federal income tax deductions for the following employees of Wolf Industries. No information was included in Step 4 of any W-4, but McCallum checked the box in Step 2C. Assume that no pre-tax deductions exist for any employees, and box 2 is not checked for all other employees. So let's look at T. Cantor. This employee has taxable income of $1,205, and the filing status is single, and there are no dependents. There are no pre-tax deductions, and therefore the gross income is also the taxable income, which we will use to look up the tax in the semi-monthly tax table, which is highlighted with a green rectangle and shows $62. Cantor does not have any children, so that is the final tax, $62. Now let's look at McCallum. McCallum is married, filing jointly, and has 2 dependents under 17. For this employee, you also have to remember that the box 2C is checked. We'll pull up the tax table and we see that the tax for a wage of $1,765 is $129, which is highlighted with a blue rectangle. Remember that we have to choose the second column because McCallum checked box 2 on the Form W-4. After finding the tax in the table, the employee's federal taxes is reduced by the 2 dependents under 17. Each dependent is worth $2,000 as an annual reduction. That means we multiply the $2,000 by 2 dependents and then divide the $4,000 by 24 because it is a semi-monthly payroll, which results in a reduction of $166.67 and reduces the total tax down to 0. High has taxable income of $1,945 and a marital status of head of household. We look up his tax in the tax table and come up with $118, $110. We still need to subtract the tax reductions for highest dependents of $2,000 per year or $83.33 per semi-monthly pay period, which results in a final taxes of $26.67. Elliot has taxable income of $2,065 and is single. We look up the tax in the tax table and come up with $165. We still need to subtract the tax reduction for Elliot's dependent, which is $500 per year because this is an other dependent. Per semi-monthly pay period, the dependent is worth a reduction of $20.83, which results in a final tax of $144.17. This example illustrates what we have to do when the employees have dependents as well as additional withholdings from a spouse's income. Moravanti Italian Imports has 4 employees and pays biweekly. Assume that box 2 is not checked for El Tarabi and R. Beninati and is checked for G. Kamen and J. Tillman. The first 2 employees, Tarabi and Beninati, are very similar to the prior examples, and that's why I won't go over the detailed calculation. Please make sure, though, that you are comfortable with the calculations. Now let's look at G. Kamen. Kamen is married filing jointly and has 3 dependents under 17. The annual salary is $21,000 and the spouse's salary is $30,000. We'll first calculate the biweekly wages of $807.69 and look up the federal income tax in the biweekly table. It's $25. So let's write down the tax that we found in the tax table. The 3 dependents are worth $2,000 each for a total of $6,000, which will divide by 26 to get the biweekly reduction of $230.77. We subtract the dependent deduction from the tax we previously looked up of $25 and come up with a tax of 0 because the dependent deduction cannot result in negative taxes. So we're not done yet, though. We need to look up the additional taxes because the spouse has income, and we do that on Form W-4 on pages 3 and 4. To determine the additional tax, we start with page 3 of Form W-4 and enter the amount from the page 4 tax table. Make sure you're picking the table for the correct tax status. In our case, that is married filing jointly. We find the intersection between the wages of the 2 spouses. Be careful to choose the column with the lowest wage and the row with the highest wage. The intersection for G. Kamen is $3,140, and we enter that amount on page 3, line 1. We don't need to complete line 2 because G. Kamen and spouse do not have a third job. On line 3, we enter the number of pay periods for the highest paying job, which is G. Kamen's spouse. The spouse is paid biweekly, and we enter 26. On line 4, we divide 3,140 by 26 and enter the result of $120.77. Since G. Kamen is the spouse with a lower paying job, the amount is not added to their federal withholdings because line 4 indicates that the amount is entered for the highest paying job. I showed you how to complete the worksheet on page 3 to illustrate the process, but you only need to determine if the employee's spouse has the higher paying job, and in that case, there is no additional tax. Let's now look at J. Tillman. Tillman is married, filing jointly, and has 2 dependents under 17. The annual salary is $31,950, and the spouse's salary is $19,170. We'll first calculate the biweekly wages of $1,228.85 and look up the federal income tax in the biweekly tax table. It's $71. The 2 dependents are worth $2,000 each for a total of $4,000, which we divide by 26 to get the biweekly reduction of $153.85. We subtract the dependent deduction from the tax we previously looked up of $71 and come up with a tax of $0 because this amount can't be negative. We're not done yet, though. We need to look up the additional taxes because the spouse has income, and we do that on Form W-4 on pages 3 and 4. The intersection between Tillman's salary of $31,950 and the spouse's salary of $19,170 is $1,940, which we divide by Tillman's pay period frequency of 26 and arrive at $74.62. Tillman is the spouse with the higher wage amount, and therefore the additional tax is added to his interim tax calculation, and we arrive at the final income tax of $74.62. I hope this video helped you understand how to calculate federal tax withholdings using the wage bracket method in situations where employees have pre-tax deductions, dependents under and over 17, have checkbox 2, and you have to calculate additional tax based on the spouse's income.